Hey everybody, Kelly Zitlow here, together with Tara Bradley.
Hello.
My longtime loan partner, strategic loan ninja guru. And this was really inspired by some of the conversations that we're having with so many real estate agents and so many buyers and just today's market. So thanks everybody for tuning in. We are going to get tactical and strategic. And Tara, I know you've been lending for, I don't know, how many years?
24.
Oh, please. What did you start when you were 6?
Yes, I did.
Anyway, and mine are just a little bit more than that. And, some of the things we've learned over the years is that every market cycle will dictate the type of skill set or approach that both real estate agents and lenders come to the market with to navigate that type of market. And I will tell you now more than ever, this is a skill-based market. So we are committed to not only making sure that our skills are honed and we are listening and bringing options to our community, but also helping real estate agents to have better conversations, because this could be very new for many of them, right?
Yep.
Yeah. So Tara, as we dive into this, we're going to show 2 different cost analysis, and we leverage a tool called Mortgage Coach when we present numbers. And I think if you're new to us, or maybe you just need a reminder of how we roll and how we serve your clients, what you're going to see today is how we present information. And we've been using Mortgage Coach for probably 10 years. Yeah. And we went to that because the whole fee worksheet, that old kind of, here's the fees that every lender has, it's part of the loan origination systems that we all use, that is not something that people can compare options with, So if they're trying to compare that with a 2-1 buy down or this or that, they just get lost. And so we're really committed to leveling up the borrower education and helping them navigate based on what their goals are and not what our goals are or what we think. Right. Yep. So Tara, we're going to kind of dive into this one. Give us a little context on this first analysis, and then I'll start sharing my screen.
So this one is, it could be a house that's been on the market a little longer. Listing agents may be looking at a seller or a price reduction, or maybe you guys think the house is worth less than what it's listed at. And instead of going in with a lower ball offer, going in and asking for a seller credit, because there's so much more we can do with the seller credit to lower their monthly payment than a price reduction. So you guys, for every $10,000 in price, it's only $60 in their monthly payment. But if we got, a $10,000 or $20,000 seller credit, we could really reduce the interest rate, which will have a much larger impact, sometimes $120 to $150 more, and or cash to close.
Yeah, absolutely. So in this case, this conversation came about with one of our agent partners that we work with. And this house, I know it's crazy, but it's sitting on the market. It's priced at $600,000. And he said they were getting ready to do a $20,000 price reduction. So even for listing agents out there, this could be a great tool to not only kind of assess or talk with your seller. Hey, are we going to get more movement by, in lieu of dropping the price 20 grand, making $20,000 available as a seller credit to a buyer? So that's kind of was how this came about. So let's share it with you right now. So in this scenario, you're going to see that what we're showing here, these are 4 different columns. So first column, second column, third column, fourth column. And the first column is really just going to portray if the seller simply just dropped the price $20,000. In that scenario, the buyer would, and this was 20% down, I think, right?
Yes.
Yeah. So in that scenario, doing 20% down, let's just call it at current interest rates, roughly 7 3/8. And remember, interest rates change every day, throughout the day, every moment, it's all changing. So this is just a quote for an example purpose. But here, we're going to show a total PITI payment. This one would include mortgage insurance in this payment, but it doesn't because it's 20% down. And we're going to show the buyer, and in this case could potentially be the seller, in this example, what the cash to close of that buyer would be without a seller credit. Yep. Then we're going to move into the next option. So this is where the strategy starts. And instead of saying, hey, instead of dropping that price $20,000, let's keep it at the $600,000 list price. From there, the buyer's still doing 20% down. But now we're going to take that $20,000 and we're going to buy that interest rate down almost a full point. So now it drops the payment from $36.19 to $34.48 PITI a month. So now we're saving, a couple $100 almost, right? $180, $170 a month. And it reduces the cash to close by $120 or by $3,000 roughly. So now the cash to close is $125,000.
Yep.
All right. What do you got there? Give it to me.
What are you thinking right now? But just like I mentioned, you guys, if like for $20,000 seller credit, now you're getting a pickup in the monthly payment of $170 versus, like I said, for every 10,000, it's only $60.
Yeah.
So
if we have people that are payment sensitive, this is another affordability strategy that we can bring to the market. And again, we're showing you that it's better to use that $20,000, at least if affordability is the issue. And that's not always the same concern for people, but it is so many people today, especially our entry-level buyers. When we go to this next column, so this column, we're going to get even more creative and we're going to say, hey, instead of using that seller credit of $20,000 to do a permanent interest rate buy down, and that's important. If we go back to this column, a permanent interest rate buy down can be helpful if the lender is running into a debt to income ratio problem. Because as we get into like 2-1 buy downs, 3-1 buy downs, 1-year buy down, the qualifying note rate, not the buy down rate, is what lenders look at. So when we're in a situation where we know we're pushing debt ratio, we may be having conversation with our referral agent of, hey, we've got to go 2-1, we've got to go permanent buy down on this client, and here's X dollars that it's going to take to get them to the rate to be able to qualify at this price point. Right. So really important to know there is a difference between a permanent buy down strategy and a temporary buy down strategy. All right. And you guys, if you have questions, just put it in comments. We're going to get to it. Susan says it's too small to see. So what can I do about that? Let's see here. And we're going to make these available to you, Susan. So let's see if this helps. Is this helpful or does that just make it worse? Put it in the comment. Let us know. I'm going to keep going and we will. Hey, Nikki, can you post in comments the actual links to both of these cost analysis, if you will? All right, so back to, is that better, you guys, from a visual standpoint? Just note in comments. Otherwise, I'll go back to the other screen. All right, I'm just going to keep rolling. I'm going to go back to the other screen because it's easier and less information on the screen. Okay, so if we go to this next strategy, this strategy is still using that same $20,000. So we're keeping the purchase price at $600,000. Now we're going to take it and utilize a 2-year seller subsidy, meaning it's a temporary buy down where the seller is going to contribute to buying that interest rate down. All we're doing is spending that $20,000 in a different light. So here, if the note rate today is 7.375%, this strategy allows the buyer to drop their interest rate payment. So their payment's going to drop for the first year based on a 2% lower interest rate. So if today's rate is 7.375 like it was in column 1, this strategy allows us to drop the payments and give people a runway into this payment of 7.375%, right? Yep. So that 5.375% would be the payment for the first 12 months. The second 12 months, that payment will increase based on a 6.375% interest rate. Yep. And then the third and final year, if they're still in the loan by then, that payment will adjust to the 7.375%. Yep. Right. So this one is, you're going to see now we start to see money in action of what happens with this $20,000. So again, back in column 1, if they were just paying with no seller concessions, paying $20,000 less for that house, here's the numbers. And if they were going to, in lieu of a price drop, use $20,000, now their payment drops to $31.02. That's PITI. It's a $500 savings in comparison to a scenario with a price reduction and no seller credit. Yep. And now we're reducing the cash to close by another $5,000. So this is affordability in action.
Yes. It's a really good option for people who, anticipate getting a raise over the next couple years. Right now, if, as the payment increases, they're getting a raise, they can afford it. Also, what's really cool about this option, you guys, is if interest rates drop before they hit that third year at 7.375, and we're able to refinance them into 6.25 or 5.75 when they drop, whatever's left of that seller money that has bought down this temporary buy down interest rate, that money goes directly to their payoff. So it's money that's not lost, where a permanent rate buy down, technically, like, it's done. That's it.
Right.
So just another cool option and something that we discuss with people.
Let's dig into that, just because you said a lot very fast, but she is so on point here. People often ask us, if the seller is going to do a seller subsidy and the buyer's leveraging that money to do this temporary buy down, what happens if the buyer ends up refinancing before it's fully adjusted back to the note rate? And what happens is they get to keep that money. It's just applied on their refinance as a principal reduction.
Yep.
So if they owed $300,000 when they get ready to refinance, and there's still, let's call it $3,000 left in their escrow account, that is an escrow account simply for the seller subsidy. It's not your tax and insurance escrow account. It's held different by the lender. Then the lender will take that balance and reduce their payoff at the point of refinancing.
Yep.
And every month they're into that temporary buy down, then there will be less available in the escrow account.
Right.
And then after the 2 years or 24 months, then it's all used. Good?
Yep.
Okay. Any questions? Just please keep it in the
Yes.
comments. We'll keep this going. All right. So the last strategy here is just another way that we could use $20,000 to help bring affordability to the market for this particular buyer. And not every buyer is payment sensitive. It's one of those things that sometimes it's cash. Sometimes it's just cash to close.
Yes.
So in this scenario, keeping that in mind, we have a little bit higher interest rate. So we're using some of that $20,000 to get the interest rate in the sixes, but we're also now going to reduce the cash to close by almost $8,000. So that, because now we're taking the rest of that 20,000 and we're applying it towards the closing cost, not the actual interest rate buy down or strategy. So
coming in with just their 20% down.
Coming in with just their 20%. So I think that, these strategies come to life, and I know that, this is a lot, and just know that we lead our buyers up to the conversations by asking them questions where we can extract what's really important. And then we build around that.
Yes.
Yes. And in certain markets across the country, seller concessions are not viable. In our market here in kind of Maricopa County, based on Crawford report yesterday with Tina Tambor, I think it was 41% of transactions with loans last month in August still had some type of seller concessions. I think it was averaging about $7,000. So that tells us that the seller concessions are still out there. It may not be on the $20,000 level, but that's why just knowing if you're getting ready to do a price reduction, reach out to us, because we can put together something like this. And maybe before you do the price reduction, you want to kind of entertain another way to bring affordability to the market and generate buyers.
Yep.
Yeah.
Yep.
Okay.
Yep. And we're happy to partner with you guys and your buyers. It's definitely something that I encourage, just like me, you, your buyer, all of us on the phone together, looking at these mortgage coach analyses, because then we all understand the strategy going into the offer and are very clear on, how to negotiate it.
Yeah,
So,
absolutely. And then just before we kind of wrap up this one, what we first showed you was really the front screen, and that's, over here with all of the yellows. But this tool allows us, again, to kind of dive deep. So now what it's going to do, which a fee worksheet lender can't do by just showing a fee worksheet, is now we're going to start to show visually to a prospective buyer how these things compare, not only from a monthly payment difference, which is what this top column is showing. We can show savings over 36 months. And this is important. We can set savings based on any type of term we want. And because we know that interest rates are very likely going to drop at some point in the next 2 years, I'm saying 2 because nobody has a crystal ball.
Right.
Man, if we had one, wouldn't that be great? Anyway, we don't.
We may not be
So,
here.
but we know interest rates are likely going to fall, and we want to make sure that we're showing numbers that are relevant over the next couple of years. So even in this scenario, with a $20,000 seller credit, let's say on that permanent buy down, that buyer is saving roughly $15,000. So it's kind of bringing the numbers to life. And then again, we can show interest paid, lots of different things that we can leverage this tool, again, based on what their wants and needs are. So, all right, we are going to now lead into Tara's. We're going to stop sharing. Let's just stop right there. I mean, you guys, this works really well when you're asking questions and engaged. This is your time. So please know that there is no silly question. If you have a question, ask it. We are here to serve you, to help break down barriers when it comes to what are all those crazy lenders talking about?
Yeah.
Right?
Yes. It's a lot to take in.
It's a lot to take in. So as we prep for the next mortgage coach analysis in the next scenario, Tara, kind of tee us up for what that looks like.
So this one is going to be fully focused on the seller subsidy or the temporary rate buy down options. And we have a really exciting announcement about our newest program, which Kelly will dive into. But so just fully focused on if the buyer, pays the buy down in their interest rate versus the lender, which is the new one we're going to talk about, and then 2 different options for the seller subsidy buy down.
So Tara, before we kind of pull this up, tell me if I'm a real estate agent and I have a buyer and the lender is talking to me about these temporary buy down options, how does the math work?
So essentially so if the interest rate is 7.375, that note end rate, and you're going to do a 2-year buy down, so 6.375, 5.375, you're essentially getting the difference in the principal and interest over those 24 months. So it can roughly be in a 2-1 buy down about 2.25% to 2.5% of the loan amount. And then we're going to show you guys a 3-2-1 buy down, and that's a little higher, about 4.75% of the loan amount. Now, those percentages are on loan amount. You ask for seller concessions on purchase price. So, one of those things, again, reach out to the lender, reach out to me. Let's go through the numbers so we know, you have to ask for X dollars or X percentage, because if you get even $5 less than what we need for that 2 or 3-2-1 buy down, we can't do it because it's got to be subsidized by the seller.
So my brain thinks in percentages. And so just write this down. If you are looking or the lender's talking to you about getting enough seller concession for a 1-year buy down, the cost of a 1-year buy down is roughly 0.80% of the loan amount. If a lender's talking to you about a 2-1 buy down, leveraging that strategy, and they're relying on you to go to the seller to get that seller concession to be able to bring that strategy alive for the buyer, in your mind, think your goal is to get 2.25% to 2.5% again of the loan amount, which depending on the down payment, the dollar amount needed is going to vary. So again, talking to the lender is important. So you understand dollars, because most agents think dollars, but I just want you to kind of see the math on the percentage of what the lender's looking at. And then on that 3-year buy down. So the 3-year buy down is pretty cool. And we're going to show you that here in a second. But on a 3-year buy down, now that start rate is at 4.375%. So now we just give an extra year of a lower payment, what I call that runway for the first 12 months. And then the second year, it goes up to 5.375%, third year, 3.75%, and then the fourth and final year. I mean, I would venture to guess, unless somebody can't refinance, the majority of people that have purchased in 2022 to 2023 will be refinancing whenever rates hit. 5.5% is kind of the mental trigger target, by the way. So strategically and psychologically, that's what the number is with all the fancy smart people that track this stuff. So not me and you. No. But back to that 3-year buy down, I'm not sure I said the percentage. It's roughly 4.75% of the loan amount. That's the cost to do a 3-year temporary buy down. All right, so let's go ahead. I'm going to show you this next scenario. And here we are going to show a buyer paid buy down. And then we're going to show you a 1-year lender paid. Ooh, that's a fun one. Hang tight. You guys are going to want to pay attention to that one. So Tara, walk us through here. So we got a $500,000 purchase price. This person's putting 10% down.
That's right. Yep.
Okay. And the 7 3/8. Tell me about that.
So that's just one discount point, one buy down point to get to that interest rate.
Okay.
And you guys, we are seeing it's about 0.5% lower rate to pay 1 point.
Okay.
Now that only is at, between no points and paying 1 point, it's about 0.5%. After that, it really starts to get more expensive. So, again, conversations we have, especially when we come, time to locking in, paying points can make sense. It may not make sense depending on the long-term goals when we think they're going to refinance. So definitely a conversation we have. But for this purpose, we just went with one buy down point.
Okay, so one discount point in column 1 puts our payment in the scenario at $35.22 roughly a month. That's PITI with PMI, since this is only a 10% down option. And the funds to close in this scenario are roughly $62,000.
Yep, good.
Okay, so now we are so excited. I mean, honestly, you guys, the marketing material is not even done yet, but don't tell anybody. Okay, tell everybody. It'll be out probably tomorrow. But we, as a company, are introducing a rate buster lender paid 1-year buy down. Did we hear that? What? Lender paid. That means you don't need the seller to contribute on this scenario. It's only going to take that interest rate down by 1 discount point for 1 year. So it's not the 2-year buy down or the 3-year buy down, but 1 year. And we are offering this on FHA, VA, USDA, and conventional conforming loans, not jumbo. Right. Okay. So in that scenario, we've got that same $500,000 purchase price, 10% down. Now that interest rate for the first year is at 6.375%. Same discount points as scenario 1. So it's the same one. It's just now we're showing you what it looks like with the 6.375% rate. And that is going to drop their payment by roughly $300 for that first year. Now, Tara, just imagine if you were to talk to a buyer or even a real estate agent, like what does $300 mean to the consumer today?
Yeah, a lot.
Right.
Yeah. Whether it's credit card debt or just all those new expenses that you have when you're purchasing a home, you need to buy furniture. It's 300 times 12. I mean, that's $3,600 roughly that first year. That's a big deal.
And that is a lender paid buy down. So again, super excited to bring that to market. If you guys have buyers that you think would benefit by that, just call or text us at 480-725-0150. That's our home loan hotline.
Yep.
And one of us will get right on it and circle back with you. But in this scenario, again, that payment's $32.22 roughly. PITI, cash to close, still $62,000. And then as we move into a 2-year seller subsidy, now we're back to that 2-year buy down, which means we're going to need the seller to contribute towards this option. This is going to take that rate down to 5.375%. So 5.375% for the first year. Second year, it adjusts to 6.375%. The payment does. And then the third and final year, it goes back to market rate of the 7.375%. In that scenario, now your buyer is going to save $588 that first year. And the second year, they're saving the $300 a month. And then the third and final year, they're back to market rate. So that's a whole lot of money.
Yep.
A whole lot of money. Yep. And then in that case, the cash to close, because we're getting the seller credit to pay for that, it remains the same at that $62,000 number. All right. Victoria, of course you would ask that question. Love you, Victoria. All right, hold that. We'll get back there in a second. And then the third option here is the 3-year seller subsidy. So hang on, guys. Wait till you see this come to life. We've got that same $500,000 purchase price, doing 10% down. Now that first year drops to 4.375% interest rate. Man, I remember those days. Weren't they awesome?
Yep.
So great to see that back here. Yeah. So 4.375%, now dropping that monthly PITI payment to $26.60 a month, including mortgage insurance, that is estimating property taxes and homeowners insurance. So that is important to know that some lenders will lowball numbers, especially at the pre-qualification stage. We do not. We want to give as relevant and close to market information that we know it's going to take for them, whether it's cash to close or costs, etc., out of the gate.
Absolutely.
Yeah. So this drops the payment to that $2,660 and still keeping the same cash to close at roughly $62,000. So let's stop sharing there. That is a whole lot of just right?
Yes.
Okay. So let's kind of use this, Tara, and bring me kind of like a real life scenario, because how many of these do you talk about every single day? Probably 12 clients a day. You're leveraging this tool based on their scenario, talking with their agent. Hey, we just found a property. The list price is X, you know, and we think that we can get enough credit to cover the seller buy down. What's the cost? So kind of bring it to life for us.
Yeah. So, I mean, in this, you guys, it can happen even in negotiations. I think a lot of seller credit comes in negotiations right now. So know that even if we start out at one strategy and you negotiate more, we can always flip to these other strategies.
Great
and
point.
It's something that we just keep on the table throughout the whole process. So, I mean, clearly interest rates are scaring people, right? It's still just the sticker shock. So these are definitely top of mind. Something that I always tell buyers, like, let's get with your agent. Let's talk strategy. Let's figure out how we can make this work. And I don't know if we didn't really talk about bid over ask, but a house is listed at 500,000. You as the agent are like, yeah, that's priced really well. We could maybe, my option that I give people is like, maybe go in at 510 and ask for a $10,000 credit. Do we think it'll appraise? Because if it will, we can use that to do some of these strategies.
Yeah, and those, as long as it'll appraise, you know, listing or coming in over ask is fine, especially if there was already a price drop, because obviously, you know, sometimes that would just indicate whatever's going on in that particular market. The house isn't moving. Maybe it needs a little bit of love.
Yes.
There's some houses that need some love out there, especially the ones that are time on market. So on that note, that there are programs out there that can help people acquire the property and do a renovation. And so they do take a little bit longer. We're not showcasing them here, but there are programs that 203K, Fannie Mae and Freddie, well, Fannie Mae has Home Style, I think, right, which is a renovation program. And that looks a little bit different in the sense that a little bit longer time to close. The buyer would need to be able to gather the bids and working with a contractor on all of that early on before close of escrow, because the house is actually appraised based on the work that's going to be done after closing. So it's a very unique program.
Yes.
And I think a lot of people forget that it exists,
Absolutely.
right? Yeah, because we haven't needed anything like that the last couple of years, because houses were just flying off the markets. And in some parts of the country, they still are, but in some parts of the country, the homes that are older or maybe are worn, that need that little TLC, they're not flying as much. So again, if you're a listing agent, you have one of those houses and you want to partner with us or any other lender to kind of, hey, put together a strategy of what a 203K might look like on this house, we can do that. So, yeah. All right. So Susan, do we have a flyer or marketing info on this lender paid benefit? We do, and it is like hot on the press right now. So it should be out, let's see, today's Thursday, 10:30. I'm gonna call sometime tomorrow. So we'll release it. And Susan, if you just want to text 480-725-0150, or anybody else on this call, and you want to have first to market on that flyer, go ahead and just text us there and just say, please, flyer in there. We'll be sure to get it to you as soon as it comes off of the presses tomorrow. So, but it is really just, we're so excited to bring it to market. And I think it's important to know that when I go back to this is a skill-based market. We spend so much time thinking strategy. Like it really is consuming. Because we realize that there are barriers out there. So whether that's a product like the one-year lender paid buy down that Cornerstone is bringing to market, or whether that's other programs that we have knowledge and an understanding of. And understanding is so important because this stuff gets confusing.
Very.
You know,
Very
it
much
really
so.
does. And again, that's why we use these tools, because it helps us to see a linear map of options, and it allows the buyer to visually see how different loan programs and strategies impact their bottom line, both on a monthly payment standpoint, over time, cash to close, etc.
Yep.
Good. All right. So any other questions or thoughts out there? Go ahead and just put it in the comment section. And if not, I mean, we've taken enough of your time. Hopefully this was value. Let us know. Please share your feedback. And we'll continue to do more of this type of education and just kind of bringing that current market, what's happening, what are we seeing, and how we can help the real estate community move through, have better conversations, and just also understands the strategies that exist. So thank you guys so much for tuning in today. Tara, thank you so much.
Yeah.
Appreciate you.
Thanks for having me.
She's amazing. We'll talk to you soon, guys.
Bye.
Bye-bye.